Think you need several $1 million to retire comfortably in North America? You might be surprised. Today, let's see whether a $500,000 portfolio can realistically fund your lifestyle and what trade-offs make it possible. The best chess players don't win by recklessly chasing the king. They win by following a strategy where every piece has a purpose. Pawns create opportunities. Knights and bishops protect key positions. Rooks provide stability. The queen strikes when the timing is right. Together they work toward one goal: make it to the finish line and win. No waiting, I'm giving it to you up front. Retirement is no different. The strategy is to have enough income and never run out of funds that produce it. Every dollar, every share should have a job. And if I retired with $500,000, I'll tell you what I wouldn't do. I would not follow traditional 4% rule. Let me show you why. Let's assume a classic 60-40 portfolio where 60% are in stocks and 40 in bonds. $300,000 in VTI, $200,000 in BND. Using approximate current yields, VTI makes about $3,600 a year, while BND makes about $7,000 a year. Total portfolio income, $10,600 a year, or $883 a month. Now assume your living expenses are $3,000 per month, which is more realistic, or $36,000 a year. That leaves a shortfall of about $2,117 every single month. Where does the money come from? You sell your investments. To me, that's like voluntarily removing your own chess pieces from the board every year just to keep playing. Now, imagine a bear market. Our $500,000 portfolio falls to $350,000, but the bills don't change. We still need $36,000. We are now forced to sell a larger percentage of what's left at lower prices, leaving fewer shares to recover when markets rebound. This is a sequence of returns risk. It's one of the greatest dangers in retirement because losses combined with withdrawals can permanently weaken a portfolio. We can't assume bonds completely solve the problem. Bond funds can decline in value and yield when interest rates rise. This is a lesson from 2022 both in the United States and Canada, and their income alone often isn't enough to fund retirement expenses. For me, that's a strategy built around selling pieces of the board. So the question becomes, can we build a portfolio that pays us instead? This is what I would do instead. $185,000 in SPYI for primary income, $100,000 in SCHD for stability, $100,000 in VXUS for diversification, $100,000 in VOO for growth, and $15,000 in NVDY to boost income while waiting for growth to accumulate. Using recent distribution and dividend rates as rough estimates, SPYI would make $22,200 a year, SCHD $3,500 a year, VXUS $3,000 a year, VOO $1,200 a year, and VDY $9,000 a year. Estimated annual cash flow is about $38,900. That's about $3,240 a month. Enough to cover your monthly expenses. Now, I want to tell you, NVDY is the riskiest position in this portfolio. Its distributions can fluctuate significantly and share price can be volatile. I don't view it as a permanent retirement holding. I view it as a temporary booster I'd hold for a year or two, collect the elevated cash flow, and if it reaches my target, rotate the capital into SPYI for more stable long-term income stream. Personally, I believe NVIDIA's business is likely to remain a dominant force in AI over the next couple of years at least, which is why I'm comfortable with a modest tactical allocation, but I intentionally keep it small in NVDY. And here's the part where many people overlook. Growth doesn't have to stop in retirement. It's possible. Let's see what can potentially happen 5 years later. Let's assume you spend the income and allow the growth portion of the portfolio to compound at a reasonable long-term rate. After 5 years, estimated portfolio value is around somewhere between $600,000 and $630,000, while you received $195,000 in cash. In other words, you may collect nearly $200,000 in cash while still ending up with a portfolio worth more than when you started. This is just a rough example, I understand. Markets don't move in straight lines, and distributions can change. Nothing is guaranteed. But to me, this approach creates a very different retirement experience. I prefer owning assets that are working to pay me while I stay invested. That's a strategy I would choose over the 4% income setup. No doubt, the 4% rule has helped many retirees, especially if the funds are in millions of dollars. I simply prefer a different path. Just like in chess, the objective isn't to sacrifice your pieces one by one voluntarily. Which strategy would you choose with $500,000 and 4% rule or income-focused portfolio? Please comment about this below. This video is for educational purposes only and reflects my personal opinions. It's not financial advice or recommendation to buy or sell any investment. Always do your own research and invest according to your own goals and risk tolerance. Let's touch base in the next one.